Okay, let's talk home office and branch accounting. For real, if you're gearing up for the Alexa PA, you know this topic in AFAR is, well, it's a headache. It just feels so confusing, right? But what if I told you it's not about memorizing a million journal entries? Nope, it's all about one big idea. Just one. And today, we're going to crack that code together and turn this headache into some easy, guaranteed points.
I bet it is. It's probably costing you points on your practice exams, maybe even keeping you up at night. You see the problem, you know the accounts, but the second that unrealized profit stuff comes up, things just get messy. It's one of the biggest traps for students. But here's the good news. Once you really see the logic behind it, you can't unsee it.
So, here's our game plan for today. We're going to start with the big puzzle, the why behind all of this. Then we'll crack the one entity code. This is how examiners think. After that, we'll decode the special account they use to track all this. Then we'll jump into a real CPAR problem to master the true COGS calculation. And we'll finish with a brain hack designed to make this info stick for 3 years easy.
Okay, so this is the absolute core of the issue. A home office sends some goods to its branch, but it bills them for more than what it cost. So on the home office's books, it looks like they made a little profit. But did they? For real? Let's dig into why the answer is a big, fat no.
Think of it like the company has a split personality. On one hand, you have the separate books. The home office records a sale, the branch records a purchase, and it all looks legit. But that's not reality. In combined reality, for financial reporting, it's just one company. It's one entity. And a company can't sell something to itself. It's just an internal transfer, moving inventory from one warehouse to another. This right here, this is everything. Seriously, lock this idea in your brain. It's like moving cash from your left pocket to your right pocket. Did you get any richer? No way. You just moved your own money around. That's exactly what's happening here. The profit the home office books, it's totally fake. It's just paper profit. It's not real money until that inventory gets sold to a real outside customer. So if we want to think like an examiner and get these questions right every single time, we have to live by this one entity code. This is the foundational rule that governs every single calculation we're about to do. And that brings us to this key term, unrealized intercompany profit. It's that fake paper profit that gets baked into the inventory's value when it moves to the branch. Our one job, our entire job, when we're making combined financial statements, is to hunt down this unrealized profit and just eliminate it, get rid of it. Because it only becomes real, or realized, when that branch sells the item to someone outside the company. So, how do we keep track of all this paper profit? You know, accountants, we need an account for everything. And in this case, we have a special tool, a specific account whose only job is to hold all that fake profit so we can deal with it later. All right, let's get into it with a classic problem you'd see in your CPA review. We've got a home office that marks everything up by a whopping 150% on cost before shipping it. You can see all the data here, the inventory, the shipments, all of it. Our mission is simple. Find the true cost of goods sold, not the fake one, the real one. Circle this number, underline it, tattoo it on your brain, 150% on cost. This is the whole key to the puzzle. It tells us that the price the branch paid is actually the real cost, plus another 150% of that cost. This is the secret decoder ring we need to get everything back to its true value. And here's our tool for the job, the allowance for overvaluation account. You can just think of this as a bucket that holds all that extra 150% markup. So when we're doing our final calculations for the whole company, our main job is to empty that bucket out, so all we're left with is the true cost of the inventory. This is it, the big one, the move that separates the people who guess from the people who know. If you can master this calculation, you will own this topic on the LECPA, period. So let's walk through it, step by step, to find the true cost of goods sold. We're not going to overcomplicate it. It's just 4 simple steps. First, we figure out the total goods available for sale at that fake billed price. Then we convert that big number back to its true cost. We'll do the same thing for the ending inventory. And finally, we just subtract. Simple as that. That will give us the real, true, uninflated cost of goods sold. Okay, let's break this down. Look at the left column first. That's the trap. That P487,500 COGS, that's the wrong answer the exam wants you to pick.
Now look at the right column. This is the right way. We take the beginning inventory, P150,000, and we divide it by 2.5 to strip out that markup. Bam, 60,000. We do the same for shipments. P325,000 divided by 2.5 gets us P130,000. Now the outside purchases, they were already at cost, so that P85,000 just stays the same. Add those up, and our true goods available for sale is P275,000. We do the same thing for ending inventory from the HO. P62,500 becomes 25,000. Subtract that and the P10,000 of outside inventory, and there it is. The real cost of goods sold is P240,000. That is the number for the combined income statement.
So what was the magic? It's all in this formula. Since the markup was 150% on cost, the billed price is really the original cost, which is 100%, plus the markup, which is 150%. So the billed price is 250% of the true cost. To get back to the true cost, you just divide by 2.5. This little piece of logic is your weapon. You have to commit it to memory. Look, it's one thing to get it right now. It's another thing to remember it next week, next month, or in 3 years when you're sitting for the LECPA. So how do we lock this in for the long haul? I've got a system for you. All right, let's do a super fast recap. First, they are one entity. Second, that intercompany profit is fake. It's unrealized. Third, the allowance account is just our bucket for that fake profit. Fourth, you always have to convert back to true cost. And fifth, that formula is your best friend. These are the 5 commandments for this topic. And here's the actual hack to make it stick. Step 1, tomorrow I want you to grab a piece of paper and resolve this exact problem. Don't look at the answer. Force your brain to recall the steps. Step 2, sometime this week, find a problem that's a little different, maybe where the markup is on sales price. That'll challenge your brain and make the knowledge more flexible. And finally, the master key. Find a friend, a classmate, anyone, and explain the left pocket, right pocket idea to them. If you can teach it, you own it. It's that simple. See? When you break it down like this and you focus on the why, it's not so scary. You're not just studying anymore, you're building a system to dominate this topic. This isn't a roadblock for you anymore. It's a source of guaranteed points on the LCPA. So, are you ready to go get them?